Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Eastman Chemical Company, ticker EMN. I noticed that it was at a 52-week low, wanted to look into it, see if it was a yield trap or what was going on, and I'm not quite sure that it's a yield trap. Things aren't looking the best, that's why it's down a bit, but it's not some massive underperformer or really a declining company. Analysts are projecting revenues to drop by 1% in the next year, but then over the course of the next 2 years to grow about 1%. So it's in a bit of a dip. It's in a cyclical sector. I'm not necessarily going to recommend buying it. Personally, I am buying it for the dividend portion of my portfolio because I do really like what I'm. Let's get right into this and see what's going on. Earnings yield, just about 8%. We'd want to get $3.32 for what we're paying, and what we're actually getting is more than double that. There's a bit of a pullback expected this year, and that's why the stock is down, but analysts are expecting it to recover right back up to higher levels next year. So they're not too worried about it and think it's kind of a short-term thing. And if that is, then this could be a decent turnaround play. Cash flow yield, it's pretty low, 7.3%. That's probably the lowest that we would really want to see it, but it is up from the average. So they do have that going for them. If we take a quick look at those cash flows, we see that there was a huge drop in 2022, likely investment or acquisition of some sort, and we could dive deeper into it if this is a stock that we think is worth buying. And then it's recovering back up from there. But if they can get back to the 2021 levels of cash flows, things would be incredible. Even 2026's expectations are below what we saw in 2021, 2022. So they did have a really nice post-pandemic rally, and it might have been a bit of a pull forward in demand for their specialty chemicals. So we can see they're growing at a pretty slow rate, about 2%, but from 2021 to 2022, they were growing 1%. So this isn't some massive growth stock, not at all. But between the dividend, currently a 5% yield, and it's a safe dividend, they have room to grow it a little bit more. Growth is about 3% per year. Might need to slow that down if revenues or cash flows don't improve. But at the current price, that is absolutely fine. And then they're buying back 2 to 4% of shares. So between those two, that's already a 7% return to shareholders. Then once you factor in everything else, small revenue growth, the share buybacks give a boost across all metrics, and you come up with something towards the lower end of market returns, 8.3%, but it's mostly in the form of a dividend. But that 8.3% is based off of today's fair value, which the stock is currently trading for like half of that. So I think if this is able to recover, this is a stock where you could see 100% returns in the value of your shares. At the same time, you're collecting a 5% dividend. Because if you look here, in 5 years, the fair value is still only $137, up 7 from today. But right now, the share price is 66. Discounted cash flow is coming in at 126. They had a really low year of cash flow, and they're recovering from that. So that might even be a low number. And everything that I see is pointing this stock towards the low hundreds in value when it's trading for 66. At one point this year, it was trading for 114, but it is not there anymore. ROE is really good, but the debt is a little high. Nothing too crazy. Just we like to see that 1 or below, and it's at 1 point. ROI and ROA are okay. It's probably about what you would expect from this stock. So they're getting returns on their investments and assets of about 1% more than they're paying out for the dividend. Gross margins, I feel like, are a little low, 24.41, up from their average of 22.69. I feel like they could have room to stretch those margins, get closer to 30%. But their net is okay. Net margin this last year was 9.65, on average 8.75. 10 is all that I would be looking at. 10 is what I would be looking for there, and they're pretty close. The PE right now is a 9, and their earnings growth rate is 11.5, which puts them at a price earnings growth of 0.8, which is one of the few companies we've looked at that is undervalued on an earnings base. And we can quickly move through the thesis here. Already touched on revenues. They're expecting about 1% if you look over the history, 1 to 2% is really what you get in revenue growth. So you're banking on them paying out a lot of what they make in dividends and buying back shares, which they do. This is definitely a larger, more blue chip stock, what you would expect for a company who's kind of hit its potential. I mean, it could acquire other companies within the sector or introduce new products. They have a solid customer base that they're selling the same stuff to and getting slow growth over time. Share count we already touched on. They're consistent about buying back shares, which is really what you want to see. If you see that taper off where they start issuing shares, then it would be a yield trap. Fundamentally, everything is sound enough that it's not a yield trap at the moment. Cash flow growth is low. Actually, I'd like to see this outperform the revenue growth, and I'd really like to see 7.5. So let's make that 1.4. And there we go, 7.5 for the cash flow yield. That's definitely not too much to ask for. Assets. Had sold off some assets about 3 years ago, but over the last 2, they've been getting more. So I'd assume old machinery that's not really working for them, and they're bringing in new stuff that's better, which is what you'd like to see. Liabilities, they're just consistently paying off those liabilities, which things are headed in the right direction with the balance sheet, even though, I mean, it's not in a terrible shape right now. It's not as good as we would like to see it, but it is headed in the right direction. Dividend, small growth, 3 to 5%, what we've seen out of them. Maybe they'll have to slow that down 1 to 2%. Even then, you have a really solid basis, and their earnings are strong enough that there's room to grow it. And then margins, like I said, I'd like to get them up to 10%. So 0.5 doesn't even really get them there. 0.75 does. In 5 years, 10% net margins. That's what I would really like to see. And that gives us average annual growth of 3.6%, which sucks. That's less than half of what you expect from the S&P. But then you factor in the dividend on top of that, and you get 8.65, which is the lower end of returns that you look for. So this one is a potential turnaround value play that's being ignored by the market right now. They saw some bad guidance for this year and kind of shunned the stock. But it hit its bottom, it's bouncing back, and it's half the value of what the fundamentals say that it should be. But they can definitely support that dividend. It's not crazy high, but it's solid. Bonds, treasury yields are at 4.1, 4.2%. So a 5% dividend is pretty solid, especially when I'm not going to say I guarantee you that the stock price is going to go up, but it's undervalued and very likely to go up. So you get some appreciation on top of that return. That's all for this one. I have actually been buying a few shares here and there lately. I had held some in the past. I know a few years ago I bought in at around 80. I sold out around 120. And then I got back in when it dipped below 100. And I was down on, I owned like 2 shares. And I was down when I got the notification that it hit its 52-week low. So that's when I decided to run the numbers on it, and it's starting to level out, bounce back. So I'm starting to invest in it, and I doubled my position in the last week. Well, I'll keep an eye on it and see if I'm going to continue investing in it. And like I said, if that share count changes from negative to positive, that would be the time that I completely would move away from the stock. But until that point, I think it's a reasonable small position and calculated risk. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.